am Tyler O'Dean. I am a Senior Director of Product Management at Blockstream, and I wanted to talk to you all a little bit today about the Liquid Network, which is one of the Blockstream projects that is specifically, I think, most interesting to this crowd and those seeking to think about tokenized assets in general. There's a lot of content to get through today, and we don't have that much time, and I'd like for there to be time for questions if we're able. So I'm going to go pretty quickly, but we'll make sure that this slide deck is available offline, and I'm also always happy to connect with anyone who's interested in this space and go into greater depth. There's a lot to talk about. Liquid is a federated open source settlement network that allows people to issue and custody assets and trade assets with strong privacy, auditability, and security guarantees, which is a very dense technical sentence. But what it really gets down to is that businesses that are issuing and trading assets that have been tokenized on Liquid can enforce their own compliance without needing to supervise their counterparties or trust a centralized authority. There is no centralized authority enforcing the rules on the Liquid network, and yet all participants on the network can have total cryptographic confidence that the rules that they need in order for their tokenized assets to be compliant within their personal jurisdictions can be true without needing to have any visibility into or insight into the jurisdictional responsibilities of their counterparties. Everyone sorts their own business out and remains perfectly private while doing so. So that means those who issue assets on Liquid can perfectly audit their investor base, and they can enforce whatever compliance rules they need, obviously KYC AML rules, but then also potentially rules about transfer sizes or accumulation of control of a particular asset without needing custodial control over that asset and without needing the asset table to be visible to the network at large or to third parties. They can prove the total quantity of the asset that has been issued and or burned, and hence by implication the supply, without needing to disclose investor holdings, which means that they can prevent rehypothecation and give investors confidence in the share of the supply that they actually own without needing to sacrifice the privacy that you would normally need to sacrifice and without anybody needing to relinquish custodial authority over their own assets. Investors can trade assets on the Liquid network between multiple parties and multiple assets in a single atomic transaction, which is both useful in and of itself because it eliminates counterparty and escrow risk, but it is also the fundamental building block of more complex and interesting financial derivatives like options and futures and things like that. Transactions on Liquid reach settlement finality in 1 to 2 minutes. So there are blocks on Liquid approximately every 1 minute. So depending on your security model, 1 to 2 minutes is reasonable. In general, unlike in most crypto economic networks, Liquid does not have reorgs. The nature of federated consensus is much more coordinated, which means that finality happens much more quickly. Also on Liquid, all transactions are confidential by default, which means that the asset quantities and types that have been traded in a given transaction are obfuscated from the rest of the network, including the validators that actually operate the network, which means nobody can know what transactions you're actually making on the network or what the economic nature of your behavior means. It means you're protected both from sort of simple front running and leaking corporate intel, but also from more complex sort of systemic threats like maximal extractable value or MEV, which has proven to be a real destabilizing force on many smart contract networks. On Liquid, the validators have relatively little visibility into the meaning of transactions and relatively little discretion over the nature of how they're validated, which means they have relatively little opportunity to interfere with the function of the network in order to benefit themselves. The MEV threat is functionally reduced as a result. In general, the most valuable thing that the network allows you to do is to self-custody assets and to trade them without needing an escrow service and without having counterparty risk, which means you can eliminate counterparty and rehypothecation risks for the assets that are tokenized on the network. What the tokens mean in the real world is a definitional agreement between the investor and the issuer. The network itself does not have any understanding in what tokens are meant to represent, but it does enforce the rules of how they behave, guarantee their supply, and guarantee that they are only transacted with in ways that are deemed valid by the rules of the token itself. As for Liquid itself, Liquid operates through a federated consensus, which means it does not have any proof of work mining. It has none of the environmental footprint of proof of work mining. It also does not require any equity-like staking token in order to power or incentivize consensus, which means it has regulatory clarity. It uses as its base transaction fee token liquid Bitcoin, which are pegged one-to-one with Bitcoin, in which anyone can create by pegging into the network. The purpose of the liquid network is to be a neutral ground that enforces transaction ordering, finality, and validity, but does not take a stance on what transactions mean or what the participants in the network are trying to achieve with them. And that allows economic models to exist within totally independent jurisdictions with totally different responsibilities and still trade with each fluidly with confidence that both rules are accommodated without needing to have knowledge of each other's rules. Liquid also is a side chain of Bitcoin, and I'll go a little bit more into what that means, but the most important implication of that is that Liquid inherits a lot of the battle-tested consensus logic of Bitcoin itself. Liquid is a UTXO system, just like Bitcoin, and the Elements code base, which is the code base that Liquid is based on, is largely forked off of the Bitcoin code base. In crypto economics, the only way to really achieve security is by putting money in a system and then seeing whether or not it is exploited. And so Bitcoin is de facto the most secure code base in the world because it has had the most wealth stored behind it for the longest period of time. And that is the strength that Liquid is inheriting from by building off of that foundational framework. Liquid itself has also been running in production since 2018 without security incidents. So it is starting to accumulate its own history of performance, but it is still a huge value add that we stay so close to the king, if you will. Liquid, as I mentioned, is a federated consensus. Here is, I think, a slightly out of date, but not crazy out of date list of the companies that are part of the Liquid Federation. Being part of the Liquid Federation is a fairly open-ended participation that just basically means that you want there to be a neutral ground where people can make trades with each other with cryptographic confidence. So I mentioned that Liquid is a side chain. This is functionally what that means. Anyone can deposit Bitcoin from the original Bitcoin chain into an address managed by the Liquid validators. Sorry, I'm saying that too many times. I'm going to say that from the beginning so that I get it clearly. Anyone can deposit Bitcoin from the original Bitcoin chain into an address controlled by the Liquid validators, and in exchange, they receive a secret that allows them to claim the equivalent amount in liquid Bitcoin. Similarly, you can go through a process to peg out liquid Bitcoin back into Bitcoin in the original chain, which means that liquid Bitcoin within Liquid is functionally pegged to the value of Bitcoin and is essentially just a receipt that allows you to cash your Bitcoin in if you ever want to exit the network. Liquid itself has 1-minute blocks. The blocks are signed by the functionaries. They have a round-robin consensus system, so they each take turns proposing a block, and then they each sign that the block is valid according to the rules. The validators have no special insight into the network. They can see all the same things that you can without any special privileges. The only privilege that they have is that they are the ones that propose blocks and sign blocks. And because the set of folks who control the proposing and signing of blocks are this set of functionaries, it means that the chain itself is extremely stable. There's no reorgs, and it can have a much faster block time than more open networks like Bitcoin can. This is like a really quick snapshot of what the sort of architecture of the network looks like. At the top layer, you have users that are able to self-custody funds and to trade with each other and with covenants, which is the smart contract technology that we use on Liquid. In a fully self-custodial way with no counterparty risk to each other or to some central custodians. The network allows for a wide range of assets. I'll mention a few of them later that are already issued on the network, and essentially arbitrary assets and derivatives of financial assets can be tokenized and can take advantage of all the things that Liquid enables tokens on the network to accomplish. The network itself is neutral on the nature of what the tokens are meant to represent, which means we have stable coins, we have promissory notes, we have debt, we have security, we have derivatives, et cetera, et cetera, et cetera. The AMP Blockstream Asset Management Protocol is a system to allow asset issuers to embed the rules of compliance for their asset into the asset itself. So I'll go into that in a little more detail in the next slide, but loosely, that's a system that allows any asset issuer to have confidence that their compliance rules are being adhered to without needing to cede control to some central authority of the network or without needing to supervise any counterparties or investors in any simple way. And then at the bottom of the stack is the network validators that are just neutrally ordering and signing off on the cryptographic validity of transactions, making sure that people have the assets that they're trading in using the zero knowledge proofs that power confidential transactions. So this is the slide I was alluding to about asset management platform. The asset management platform essentially allows the issuer of an asset to be a co-signatory on future trades of the asset. So because Liquid is a UTXO system, we have native multi-signature rather than needing to emulate multi-signature in a smart contract, which, side note, is the source of a lot of the exploits that you see in the DeFi ecosystem, particularly bridge exploits. We support true native multi-sig, which means that the signatories don't have to trust each other. They can be fully and completely segregated. They might even be counterparties in a trade. In this case, the signatories would be, one would be the asset holder and the other would be the asset issuer. And the asset issuer can use whatever sort of discretion they want in order to enforce the set of rules that they need to stay in compliance for their particular asset definition. So in a lot of cases, that'll be simple KYC AML, but it may also be more complicated rules about their cap table or about whatever distributional rules might apply to the particular asset that they're defining for their use case. AMP is a neutral technology, just like the network itself. You can think of Liquid itself enforces the validity of transactions in an absolute sense. And then AMP allows every asset to add its own idiosyncratic rules of validity on top of the base rules of the network. That allows everyone to build custom compliance for their particular jurisdiction and still trade in a completely neutral field. So again, what are the sort of base value propositions of the Liquid network? The most simple and obvious one is confidential transactions. Unlike most crypto economic systems, the transactions on Liquid are confidential by default, which means you can have true corporate intel be transacting on the network without fear that your counterparties will see it, without fear that it will become public to whatever third parties might be deleterious to your business interests. In general, the purpose of confidential transactions is to allow you to confidentially act on the network without needing to worry about supervision. It also prevents front running and it prevents MEV. So it's useful in sort of more systemic ways as well. Liquid is also built from the ground up for regulatory clarity. There was no pre-mine, there was no ICO, there is no equity-like token. There is no system within Liquid that requires additional regulatory definition in the way that many systems have a sort of a token which may very well be declared to be a security of some kind, but is still currently in an ambiguous state. In addition to that, Liquid is built from the ground up to enable native enforcement using the AMP system. It allows compliant tokens from the very beginning as a sort of natural constituent of the network. The purpose of Liquid is to enable tokenization and digitization of assets that still want to maintain regulatory relevance, still want to be part of the TradFi system, but want to take advantage of the rapid settlement and the covenant smart contracts and the various other properties that are achievable, the rehypothecation protection, the self-custody, the things that Liquid enables tokens to do without necessarily seeking to exit any particular jurisdiction. Liquid is built to enforce and enable those use cases rather than to sidestep them. And fundamentally, Liquid is a platform that's built for what I like to think of as industrial grade security. So one of the reasons that we see a lot of the security exploits that we see in the DeFi space is because there have been a lot of shortcuts taken. The shortcuts are helpful for building rapid prototypes and trying out wacky new things, but they're not helpful for when you need to put really serious grown-up degrees of finance into those rails and have confidence that they will perform in the way that you expect. And Liquid is intended not for simple prototyping, but for really profound, serious use cases. And a simple example of that is that what we're working on right now is a language called Simplicity. Simplicity is a deceptive name. It's a challenging language to work with. It's a little bit close to assembly. But the reason that it's useful to be able to build smart contracts out of a language that is so close to assembly is that it allows you to do fundamental mathematical validity proofs about the nature of that smart contract's behavior. So it's a little bit more challenging to build, but then on the flip side, you're able to mathematically prove that the smart contract is only capable of paying out to you or your counterparty, and thus is incapable of paying out to some third-party exploiter, no matter what they did. That's a simple example of what you might do with a validity proof. Validity proofs are really powerful. They're often used in systems that use OCaml today. So if you're familiar with the advantages of OCaml, you can make a similar inference to the advantages of Simplicity. Simplicity I use as an example. It's a future-looking thing we're developing, but in general, Liquid and the UTXO architecture is built from the ground up to have a serious weight towards long-term security, long-term confidence, the confidentiality, and the total certainty that you need to be able to put billions and trillions into the system. Liquid is built to sustain the true economy of the world and not just a series of interesting prototype examples, which is what we've seen mostly in the crypto economic space to this day. So to give you a few examples of some of the things that are being done on Liquid today, this is a couple of the exchanges that you have that take various approaches on the nature of what parts of an exchange should be custodial and what parts of an exchange should be non-custodial, various points along the spectrum of decentralization. I don't want to get too much into the details, but they're all very interesting in their own regard, and each of them offers a different set of trade-offs than what's possible in the traditional financial world today. We've talked a lot about FTX over the course of this morning. I'm sure it will continue to come up over the rest of the conference. In general, FTX is a really good example of a threat that, while not synonymous with crypto, is certainly very relevant to crypto. And these systems are meant to allow traders to engage with exchange-based use cases without needing to expose themselves to the kind of rehypothecation, misallocation, and appropriation risks that FTX ended up being such a dramatic example of. Some other tools that, I already talked a little bit about AMP, so I won't repeat myself there. But Blockstream Jade is our hardware wallet, which allows you to store Bitcoin and liquid assets using a full hardware wallet. You're also able to use it with multi-sig if you're a sophisticated user with a serious use case where you want true desegregation of private keys. Boltz is a really interesting use case. It's had a lot of growth recently. Boltz is a non-custodial exchange between both Bitcoin, liquid Bitcoin, and the Lightning Network. So it's a way to fund liquidity to Lightning channels or to withdraw liquidity from Lightning channels into a Bitcoin-like system in a cheaper way. So they've had tremendous growth in Liquid recently. Liquid, I believe, last I checked, now represents around 65% of their overall volume. So Liquid is essentially the leading system that's attempting to build these crypto economic use cases on the example of Bitcoin, building with a true long-term future in mind, building with fundamental security, building with privacy, building with a serious intent to not enfranchise a new centralized authority, but instead to build a system that actually does not have a centralized authority with any special privileges, and to build the governance system that can help make that a long-term part of the crypto economic future. So that's what I've got prepared. And now I'm going to pause, give myself a sip of water so I can clear my throat. And then I would love to hear any questions that might occur, because I know I just talked about a lot of stuff very quickly. So have we seen any questions come through on the chat? You're on mute, I think.
No questions yet. You're good to continue.
Okay. Well, I don't have more slides, but what I will do is kind of highlight a couple of the use cases that I think are particularly interesting examples of what's being done with Liquid today, and what I think may be inspiring for folks to contemplate how to incorporate into their own use cases. Mifil is a company based out of Mexico that handles, among other things, promissory notes. So promissory notes are a form of debt in Mexico that happens to be particularly privileged by local debt laws. So it's a particularly desirable way to hold debt. But it is a local paper instrument, and it therefore struggles to access the global liquidity, because in order for global lenders to have confidence that they're not dealing with rehypothecation risks, they have to have an individuated trust relationship with the issuer of that promissory note. So what Mifil is doing is Mifil is tokenizing promissory notes and then letting those tokens serve as pristine collateral to global lenders who are now comfortable lending against those assets because they have greater confidence in the total supply and in the lack of rehypothecation risk. And then that additional liquidity is being used to create more tokenized promissory notes in Mexico. So there's like a flywheel there that basically amounts to a locally valuable but stranded asset is able to access greater global liquidity by eliminating trust relationships and replacing them with cryptographic proofs. So Mifil says, don't trust me that this is how many notes I have. Use the cryptographic proofs of Liquid to know how many notes I have issued and how many you hold. And then you will know that that is the ratio of the assets that you have claimed to. And Mifil basically just serves as an anchor point connecting the traditional financial instrument and all of its legal privileges to the tokenized asset and all of its cryptographic strength. And by doing that, they're sort of enabling both markets to access each other in a stronger way. Another interesting use case on the opposite side of the world is Japan, where Digital Garage has a product that they call SettleNet. And SettleNet allows mostly cryptographic exchanges are the ones that are using it today, but my anticipation is that this will be a much more widely needed banking service over time, which is exchanges of pairs between liquid Bitcoin and their Canadian and Japanese yen pegged stablecoins. So for exchanges that want to be able to purchase either stablecoins or liquid Bitcoin in order to rebalance their exchanges locally as their customers either buy or sell, they're able to do that in a single atomic asset swap, which and then with 1 to 2 minute settlement times. So they're able to transact much more quickly and with a much smaller degree of exposure in order to top off their coffers between the Japanese stablecoin or the Canadian stablecoin and then liquid Bitcoin as usually the counterparty of the pair. But fundamentally, you can do that same asset swap settlement across any two arbitrary tokens on the network. Another interesting use case is SideSwap, which is a decentralized asset exchange that allows users to do one-to-one pairwise swaps of any arbitrary assets without needing to trust each other or SideSwap itself. The whole thing is done in an atomic transaction so that you as the user never actually have a moment where your asset is gone, but you haven't received payment. The moment where your asset leaves and the moment where you receive payment are a single atomic transaction that are confirmed simultaneously by the network. Another interesting example of something that's happening on the network right now is Fuji Money. Fuji Money is a stable coin that is backed by Bitcoin itself. And the way that it works is that users that want some access to liquidity on their Bitcoin without relinquishing self-custody can lock some Bitcoin up as collateral, receive some Fuji Money as a sort of loan against that collateral. And then there's a process by which people can claim those vaults if the value of Bitcoin goes below a certain threshold. So functionally, it creates a Bitcoin-backed stablecoin in the market for arbitrageurs who want to buy Fuji stablecoin in order to close out whatever vaults are in arrears or what have you. So that's another interesting example of what's happening. And what's cool about Liquid is that each of these different systems can have greater or lesser regulatory scrutiny. They can have greater or lesser degrees of controls or restrictions on the nature of how the asset is used, and still be able to all interoperate smoothly. And a user can choose to bridge across whatever suite of those assets is relevant to their portfolio without there needing to be any centralized authority that understands simultaneously that rich, diverse suite of potential rules that are being adhered to. So like the Japanese regulatory environment and the Mexican regulatory environment and the various regulatory environments that are involved in all of these different products can all interoperate without having knowledge of each other and without needing any sort of central authority. So yeah. That's pretty much what I have to say today. I'm happy to answer any questions that folks have, if there are any that have come up. Or perhaps I was just so stunningly convincing.
Oh, that's all.
I've seen some Q&A.
Oh, you see some Q&A? Fantastic.
Great. Curious on how the regulators view the anonymous counterparties and assets. How is this handled? So the nature of the network is that the network doesn't have any knowledge of its counterparties, but you as a user are entitled to enforce your sort of discretion over what counterparties you want to be allowed in the assets that you issue. So if you are issuing an asset and you are concerned about the risk of anonymous counterparties, you can use the AMP system to basically restrict the set of addresses that are allowed to hold your address or allowed to hold your asset to whatever list you like. And that can be a list that you have individually KYC AML'd, or it could be a third-party service that offers KYC AML as a service and just allows you to say, like, I want to be available to European investors or US investors or whatever might be relevant to you. So the network allows for anonymous interaction, but it's up to the asset issuers what they deem as a valid interaction for their asset. The next question, can we talk about interoperability? How does Liquid interact with other blockchains? In general, the nature of blockchains is that they are aware of themselves and not aware of other blockchains. The two ways that you see interoperability between networks are a centralized bridge, like an exchange that just allows you to deposit on one network and withdraw on the other, or a smart contract that emulates the behavior of a centralized exchange in a hopefully compliant and sensible way. In general, writing those smart contracts is extremely difficult, which is why you see so many bridges with multi-million-dollar exploits. So I don't really think smart contract bridging across blockchains is a wise security practice. I think if you do want to cross blockchains, you're probably better off building a trust relationship with a specific party that operates on both chains, or being that party for yourself. We have the next question is, are the tokens settled on Bitcoin or are they off-chain? So the nature of Liquid is that it has its own chain. It is a side chain to Bitcoin. And then you can deposit Bitcoin into an address that's relevant to the side chain, and then do things on the side chain, and then withdraw back out onto the original Bitcoin chain. So it has a relationship to the original Bitcoin chain. You're able to exit back out again, enter and exit from the Bitcoin chain, but it has its own chain, and that's why it's able to settle at 1 minute times as opposed to 10-minute times. So it does actually have its own, I don't know if I would go so far as to call it off-chain, because there is still a base relationship, but it is not, each of the transactions is settled on the Liquid side chain, and the only time that you have a presence on the Bitcoin chain is if you're actually withdrawing back out in a peg out transaction. The next question is, what are the costs per transaction? I don't remember off the top of my head, but the Blockstream website does have a block explorer that lets you look at any given time. In general, the Liquid network is very similar to Bitcoin, but has blocks about 10 times as often. So we usually have lower fees. That's not a fundamental property of the network. The network is congestion priced, just like Bitcoin is, so that it is an auction for block space, but we have a lot more block space, and we have a lot more luxury to expand block space because we're working with a federated set of validators, as opposed to needing to make it so that like someone with a Raspberry Pi and a satellite connection can still stay connected to the chain, which is something you need for a chain like Bitcoin. What is the Liquid chain? It is an elements-based chain. It inherits a lot from Bitcoin, so it operates very similarly to Bitcoin, but rather than using the proof of work to validate which block is valid, there's just a set of permissioned validators that are approved by the Federation, and those are the miners, if you will. But other than that, it's very much like a Bitcoin chain that's 10 times faster and has a few extra bells and whistles. It is literally called the Liquid chain, which is sort of a bit redundant, I suppose. It's entirely possible also to use Elements, which is the code base that powers the Liquid blockchain, to run a separate parallel network. So, you or I could go off, fork the Elements code base, or not even fork it and just run it ourselves, but with our own validators, and have a Liquid-like network that was with a federation that we preferred for whatever reasons, and maybe had different rules in service of the goals of that federation. Liquid, I think of as being the network that is aimed at being the most neutral, but you could conceive of other networks that are interested in the federated consensus, but maybe are aimed at a more focused jurisdictional target. Are the two parties of the atomic swap the only ones that can see information about the transaction? That's a great question. Everyone on the network can see that a transaction took place and the two parties involved in the transaction. No one else on the network can see what the assets exchanged were or what the quantity of assets exchanged were, just that a transaction took place. Everyone can verify that no tokens were created or destroyed in the course of the transaction, so we can all verify that the supply has remained stable. And then the two parties of the transaction are in possession of unblinding keys that would allow them to, at their discretion, unblind that information, possibly to a third party, or if they wanted to, they could do it more publicly. I don't know of a practical reason to do that, but there might be some clever cryptographic game you can do by later revealing unblinding keys. So the two parties of the transaction have a secret key that they could release that would reveal the nature of that specific transaction if they so choose. So they retain the ability to relinquish privacy later. The data isn't lost. But if they choose not to, then the transaction, the only thing that's visible to the broader network is that a transaction took place, not the nature of what the transaction was. Well, I think that's all of the questions so far. Get them in if you want to get any last minute questions in. Otherwise, I'm also always happy to catch up offline. Well, thank you. I'm going to stop sharing here.